Thanks, Sam. Good afternoon, everybody out there. Thanks for taking a couple hours out of your day to listen to what I'm sure you've been hearing a lot about and doing a lot of reading about over the last couple months, and that is the new mortgage rules. Now, the angle we're going to take on this, in other words, the way we're going to discuss them is a little bit different because understanding that we compliance nerds can kind of, and I say that affectionately, of course, since I am one of them, we can bury ourselves in the office and shut the door and read the rules section by section and figure out what's going on. But then that doesn't really have a lot of utility and usefulness when it comes to actually incorporating and putting these rules into operation within your bank. You know, you've got different people doing different things in the bank. You've got the processors and the underwriters and the loan officers and the asset recovery group and the different group that does foreclosures, and you've got your IT staff. So in other words, scattered throughout your institution are a lot of different people that are going to be impacted by these rules. And part of what you have to do is sort out who's going to have to do what in connection with these rules. So that's what we're going to talk about here. Rather than go through the rules piece by piece and rule by rule, we're going to talk about the actual loan process, and we're going to go through it here. And I'll show you a little map that I put together. If you've looked at the presentation before you attended here today, you'll see kind of what I'm talking about, but we'll make a little more sense of it as we go forward. But the idea is that you need to focus on various groups within your bank and figure out who has to do what, and that's what we're going to do here, and talk about the provisions of each of the rules in turn that applies to each of the particular groups. And if you go to page 2 of your presentation here, the theme that we really want to convey today is that these rules are going to influence, and they do influence, your entire mortgage loan process. Of course, we all know it's going to have a great deal of impact on the industry. And as a result of that, there are a lot of important decisions to be made that a lot of banks have been looking to and figuring out what they're going to do and whether they're even going to stay in the mortgage marketplace as a result of all these. And we talked about that in a webinar a couple weeks ago that you may have listened into. But here we're going to talk about how you actually put these things into play. Now, I mentioned that previous webinar simply because I'm going to revisit a couple of those questions because the answers to those questions are then going to influence the groups of individuals and employees in your bank that you have to respond to and get to do certain things. So there are a lot of moving parts with this, of course, all the different rules, the different people involved, and your strategic decisions and what your bank chooses to do or maybe not do as a result of that. So if you look at this page 2 of your handout here and the slide page, of course, we have a lot of implementation hassles, and I say that lovingly, I guess, because in the end, that's really the job security that we compliance people have, is to make sure that operations are working effectively in compliance with the rules. But I kind of give I'll spit it out here, a little breakdown of the various areas in your institution that are affected, whether it be product development and the underwriting and pricing functions, all the way through the policies and procedures that you'll have to draft. But of course, again, some lenders may choose to exit the market, and that may present some opportunities for your institution to seize a little bit more market share simply because there are fewer competitors. And one of the decisions you'll have to make is, if we choose to stay in the marketplace, will there then be an opportunity to expand the reach that you have because of the decisions that others make? And then, of course, there are fair lending and UDAP issues here as well, and that kind of permeates throughout a lot of these rules. But the answer to some of those questions is far not only as what we're going to do, in other words, what types of loans are we going to make, what types of loans are we not going to make. You may decide, well, we're not going to make any HOPA loans, we're not going to make any loans that aren't qualified mortgages. What is the impact on that of that decision on your lending area and on your HMDA data and the geographic analysis? In other words, might you have a redlining issue going on? So some of the many issues you'll have to address and then, of course, put into operation or operationalize, if that's really a word, but I think you know what I'm talking about. So if you look at page 3, one of the first things we need to address here is the coverage of the rules. And I will tell you this is one of the more frustrating aspects of the rules in that each of the rules has a different applicability. It applies to maybe it's open-end to closed-end credit, first lien or junior lien secured by a principal dwelling. Whether it's a qualified mortgage, there's a whole lot of exemptions and exceptions and qualifiers, and extremely difficult to figure out exactly what types of products these rules apply to. And, of course, you have to know what the application of the rules is to know what areas of your institution are affected. And some banks out there, some lenders make all their mortgage loans in a mortgage loan department, but others may make some of the home equity loans in their consumer loan area. You may have a private banking area or wealth management division that may make some mortgage loans. Of course, every bank has their own unique structure. But, of course, to understand what areas you need to approach and say some changes need to be made, you need to understand what rules apply to what types of loans. So I've got some notes around that just so we can set the stage of all these processes here to figure out what applies to what. So looking at page 3, remember first and foremost that these are Reg Z and RESPA rules. For the vast majority of them anyway are Reg Z and RESPA. There is a Reg B rule that affects appraisals. Now the point of this is that Reg Z and RESPA impact and affect only consumer purpose loans. So you don't look at the character of the collateral per se, but you look at the purpose of what I want to do with the money that I'm borrowing from you. And if it's not a consumer purpose transaction, Reg Z and RESPA don't apply. Therefore, all of these rules, whether it be ability to repay, QM, escrow, servicing, homeowner counseling, all of those things won't apply. But, of course, the Reg B appraisal rules do apply to commercial purpose transactions. And we'll get into that here a little bit later as well. But remember that if the collateral for the loan is a 1 to 4 family residential dwelling, doesn't matter whether the loan has a commercial purpose Reg B, and therefore the appraisal rule will apply in that instance. For all others, however, it will be consumer purpose only. Second part, when you're looking at types of transactions and thus where in your institution these may be made, understand that these rules apply only when you have a transaction, and you see that term as in quotes. What that means is you have a legal obligation, whether you call it a promissory note or a credit agreement or a loan agreement. Different states call it different types of things, but it's got to be a legal obligation signed between the lender and the borrower, saying the lender will advance such an amount of funds, and then borrower agrees to repay it back according to certain terms. Now, that is what you need for Reg Z and RESPA to apply. What it means on the flip side is that a modification to an existing transaction where the existing promissory note is satisfied and replaced, that is not a transaction under Reg Z and RESPA. Thus, these rules don't apply. So where you have a modification, now that is the legal term modification. I don't care what you call it. You may call it a refi or a consolidation or a cash out or whatever the case may be, but if there's no new promissory note, it's not a transaction under the rules, and they just don't apply. Now, of course, look at the last note on page 3, which you want to impose a requirement in a modification that you couldn't ordinarily impose during a transaction, and I think the answer is probably not. So although there's no regulatory problem, there's no violation per se in place here, certainly would be seen as a way that you're trying to circumvent the rules, thus the provision would apply. So be a little bit careful about that. Look at page 4. As far as some other issues on coverage of the rules by product here, one of the impressions that you might want to dispel of some of your loan folks is the fact that these rules apply only to closed-end credit, only to closed-end mortgage loans. Now, that is mostly true. There are 3 provisions that do apply to open-end credit, but for the most part, the rules apply only to closed-end loans. But be sure not to have that limited mindset when you're considering what types of loans are covered under these rules. So you see the note I have at the bottom of page 4 on the home equity lines of credit. The ability to repay rules do not cover HELOCs. Thus, they cannot be qualified mortgages because the qualified mortgage provision is a way to comply with ability to repay. So you won't have a QM HELOC per se. Now, does that mean then that you would not assess the consumer's ability to repay? Now, the answer is you probably would, and you're probably doing so anyway, but it's not a regulatory concern that you verify the ability to repay under these new rules, for example. So that distinction I'm making here, it's important that you understand where your HELOCs might come